Welcome to Futures Now. I'm Courtney Reagan, filling in for Jackie D'Angelis today. We're live at the commodity desk at CNBC Global Headquarters. My wingman on the show today, Jim Urio and Brian Stutland, coming to you live from the floor of the CME in Chicago. But let's get down to business. Here's what's on the show today. The weather outside is frightful, with howling winds and snow turning the Northeast into a winter wonderland. That usually bodes well for nat gas. However, prices are at a standstill as a storm rolls through. Our traders will trade the commodity, but that's later on. Plus, bonds breaking a three-day win streak and tumbling today. But could the breakdown create a buying opportunity? Our traders will weigh in on that, too. But we start with the market trifecta. The major indices hitting new record highs today. But former OMB director of the Reagan administration's David Stockman says that the market free fall could be ahead. And that's all thanks to President Trump. He joins us now live to explain by phone. David, thank you so much for joining us today. I understand you have been a longtime critic of the Trump administration. Does that continue? When are you going to throw in the towel? Where do you stand right now?
Well, what's going on today is complete insanity. The market is apparently pricing in a huge Trump stimulus when, if you just look at the real world out there, the only thing that's going to happen is a fiscal bloodbath and a White House train wreck like never before in U.S. history. I mean, how much evidence do these so-called traders need? Trump is lost in Twitter land. He's out of control. He's turning out to be a complete jackass in the Oval Office. Co-President Bannon is off the deep end on terrorism, travel bans, Mexican walls, immigrant bashing, protectionism, nothing to do with the economic agenda. He's got an empty economics bench, no Secretary of Treasury, no OMB director, no CEA chairman. By this time, when I was there in the Reagan administration, the plan was ready to go, and he was going to Congress within a couple of days in February. We have a debt ceiling freight train coming down the road, which will hit March 15th, and then the cash will start running out, and the system will be on edge. All the continuing resolutions expire in April. They're going to spend the year trying to repeal and replace Obamacare, and it'll be a fiasco. So nothing is going to happen this year. I don't even think they can pass a budget resolution. There's going to be no tax action this year. If there's any bill next year, it'll be deficit neutral, which means it's not going to add $15 to earnings like these crazy people expect. And so why would you be trading this market with this kind of chaos emerging everywhere at 26 times trailing earnings? That's where we are. It is completely crazy, and it's only a question of how many more days or weeks this kind of fantasy land can last.
Well, those are certainly some fighting words, and traders are very dear friends to us here on this program as well as throughout CNBC. So it seems like you're just not believing in the trend that everyone else is. I mean, at what point do you finally give in and say, hey, he's atypical, but maybe he could get things done? I mean, look at all the CEOs that he's met with so far. Does that not mean anything to you for pushing forward agendas that may help Wall Street?
No, I mean, CEOs come in on every president. They came in on Reagan and everybody else, and they tell a president what they want to hear. I mean, these guys are just selling a song and dance about how many jobs they're going to create in the next 5 years. They have no clue. If we have a recession in the next 5 years, which surely we will, because, recessions haven't been outlawed, and we haven't had one, for 10 years by then, none of this stuff is going to happen. So this is meaningless. What is meaningful is that Trump is out of control. This tweeting, getting off track on all of this terrorism stuff. This is a sign that there is going to be no governing coalition, and that all of this, economic stimulus, fiscal stimulus expected by Wall Street is a complete fantasy. It can't happen.
So our traders are here, and I know that they've got a question. Jim, you got to jump in here on this.
Okay, David, let's take Trump out of the equation for 1 second. I know that that's difficult to do because there's a part of this that I keep looking at, and that for 8 years Barack Obama was in office. Both times he ran on a platform of reining in corporate excess. Every turn he tried to increase regulation, and he made it very clear that he was against the corporation. He was fighting for what he perceived was the common people. Him being gone, to me, seems like a big plus. Are you going to give me that at all with this rally? Are you going to acknowledge that or no?
No, because, I think he was a very bad president, and the regulation wasn't any good, but it's going to take years to unwind it. Trump is just putting out press releases in the guise of executive orders, but all this stuff is going to get litigated. It goes through a rulemaking process that takes years. So the relief on regulation will be important, but it's way down the road, and it won't be that impactful. The second thing is we're at 92 months in this expansion already. It's running out of gas. You can't expect it to last forever, and that's seemingly what is priced in by the market. The third thing is we have a giant debt and deficit problem. This the debt ceiling's coming back into play. It'll be $20 trillion when it freezes in on March 15th. And I'll tell you this, people aren't paying attention to the fact that Trump will never get a debt ceiling increase through the Congress without a government shutdown. And when that happens, it's Katie bar the door because nobody's expecting it. So we need to look at the facts, not the hopes.
David, I know that you're looking at history, and that is something that's often very smart to do, to keep it in the rearview mirror at the very least so that we don't make the same mistakes. But that doesn't mean that history always repeats itself. Just because we've had this rally that's going on 10 years doesn't necessarily mean it's going to end tomorrow.
The market is clearly pricing in a big Trump stimulus, and I think anybody down there would admit if it doesn't happen, if we get zero tax cut, if we get a fiscal bloodbath in the Washington, as I'm describing, then the market is not going to stay where it is today at these absurd multiples of earnings. This is all based on the idea that there's going to be a surge of economic growth and that profits are going to come back from about $89 a share on a GAAP basis where they were in the last 12 months to, who knows, $110, $130. My argument is there's not going to be any economic rebound. There's not going to be any profit surge, and therefore the market will, be repricing dramatically downward once it's clear that that's the case.
Brian Stutland, go ahead and jump in here. I know that you pay very close attention to the market levels and pricing and repricing.
Yes, yeah. So, I mean, when you take a look at this thing, I agree with you that the stimulus package may take longer than normal, but who in Washington is really going to push back against Trump on what he wants to get done? And the Republicans themselves will probably sort of push their way through eventually. I anticipate that this happens much later in the year than people expect, so I somewhat agree with you that there'll be some delays. But when the dust settles and you get a volatility shakeout, isn't it true that, listen, we have jobless claims hitting 43-year lows, we have manufacturing increasing, we have interest rates at near and record low levels here. So what is it in the market? The valuations seem that the market points to a higher direction ultimately by the end of the year, doesn't it?
No, because the market is assuming that profits are going to rebound, that we're not going to have any economic dislocations, and that nobody's going to be pushing back on Trump. I mean, it's hard to understand how people watching the day-to-day action down there could believe that. Everybody's pushing back on Trump. He can't even get his cabinet approved. He's going to be bogged down in a Supreme Court fight. He's going to be bogged down in this fight over this ridiculous travel ban, which he should have never done in the first place. So the idea that there isn't going to be pushback, I think, is exceedingly naive. What there's going to be is a train wreck. It's already clear that the people in the White House have no idea what they're doing, and it's only a matter of time before all this honeymoon goodwill evaporates and the politicians get down to the business of doing what they do best, which is to undermine and obstruct anything that might be positive. So
David, you're certainly entitled to your own opinion, but I'm looking for a little bit of hope here. Is there anything that you would see that would make you turn a little bit bullish, presuming that Trump is going to be our president for the next 4 years?
No, because he's inheriting 30 years of a disaster created by his predecessors. We have to take this $20 trillion of debt seriously. There's $10 trillion more built in under current policy, even without a dime of Trump tax cuts or infrastructure or stimulus. There is going to be a tremendous fiscal crisis in the years ahead, which will prevent any of the kind of stimulus that the market stimulus junkies have been living on for several decades now.
Well, thank you very much, David. I don't think that there's any confusion about where you stand. So we do appreciate that you joined us again, David Stockman. Thanks.
Thank
Jim,
you.
so how are you trading the S&P futures? I feel like we got to talk out what we just heard.
We got to take a short-term breath here. Yeah, right now we're trading about 22.03. If the March contract backs up to about 22.97, I think that's a spot to buy it with a target of 23.17 on the upside. Yes, I did say buy it. A stop placed back below 22.85 seems reasonable. I hear the thing that David Stockman's saying. I understand that he's not a fan. And many of the hurdles and pitfalls he talks about are certainly very real. Maybe some of the things he says come to fruition in 6 months, but I don't know. For the short term, it seems like the trend is your friend and you go with it.
And so you are much more bullish here. You're hearing what he's saying. You're just not buying into the logic for what you're doing in your trades.
I am much more bullish. I think that to have he said that regulations aren't going to be repealed. Yes, but now we don't live in the shadow of new regulations coming every couple weeks. This is a much better business environment, and you see promise and optimism in many different sectors. But one of the things that I like the most is last Friday when we saw the jobs numbers were relatively solid, and the wage growth part of it was not. So that means the one pitfall that I saw was that perhaps the Fed gets a little too aggressive and starts raising rates, and that pushed the Fed a little bit further back. So I think this is a decent scenario for stocks. I'm not saying people should just jump all in. I'm saying that I'm playing it from the long side.
And we could have some kind of tax announcement in the next several weeks. At least that's what the president alluded to today. I think the market's going to have to game out what that means, especially for a lot of these businesses, where it could help them very much, regardless of the timing, whether it's next year or sometime in the future.
Amen to that. That's what we're hoping for, and we want to hear that rhetoric. I mean, we don't have to have. Remember, the oil markets needs to see things change. The stock market can trade on promise for a long time, so we don't need to actually see regulations and taxes change as long as we believe that it's going to happen and hear the necessary rhetoric.
That sentiment, it's so key. Okay, Jim, so what's the risk reward on this trade?
If you buy at 22.97 and get out at 23.17, that's 20 ticks. That's $1,000. If you're stopped out at 85, 12 ticks below is 600. So it risks 600 to make 1,000.
All right, that is trade number one for you all today. But let's move on to bonds. There's still more to talk about. Down today after a 3-day winning streak. So, Jim, how are you trading the 10-year when you put in everything together that we've learned today from the president about potential tax announcements coming forward? I saw a little bit of movement after we heard that.
Okay, my bond trade is a little bit different. Where I think 125 even is a spot to buy the March 10-year with a target of 125.24 on the upside. A stop back below about 124.18 seems appropriate here. And I'm basing this more on the fact that rates moved fast since the election. From a relativity standpoint, rates in Germany are still 30 basis points for the 10-year. Rates in France are still below 1% for the 10-year. Our 10-year looks relatively attractive, and I think there's enough money to go around globally to boost our stock market and our bond market.
Brian, what do you think? You want to get in the same boat as Jim here?
I would push back a little bit on this situation. I think you saw Treasuries recently rally because you heard Trump actually pick up the phone and call China, or at least they said they did. And people said, well, maybe they'll work some things out there and that'll calm some issues down. And Treasury started rallying on that China doesn't need to dump their bonds that they're holding in the U.S. But I think other than that, you talked about global interest rates. I get it that the 10-year is more attractive, but we have seen the German Bund yield start to rise now. We have seen some European rates start to jump up a little bit. We have seen a little bit of inflation coming back into Europe. And so, to me, I think the U.S. Treasuries are less attractive here. And I think until you see the 10-year above 2.5%, I'd rather not be a buyer. I'd rather hold off and wait on that a little bit.
Yes, I agree with you that European yields have started to go higher, but they didn't go nearly as higher as quickly as U.S. rates did. So all I'm talking about is a little bit of a mean reversion. Remember, we always joke about this is futures now, not futures next week. I'm talking about what could be a relative short-term trade.
But I think even in the short term, I'd rather wait a little bit, see the 10-year get above 2.5.
Trade, a buyer and a seller.
And this is coming from someone that I am long U.S. Treasuries all the way out onto the 30-year part. I just haven't put all in yet. I've only put about half of what I've wanted to allocate to the Treasuries because I'm waiting for those yields to move higher.
Okay, Jim, so bottom line, what is the risk reward on the trade that you want to put on here?
If you buy at 125 and sell at 125.24, it's a gain of 24 ticks. It's $750. If you sold it at 124.18, that's a loss of 14 ticks, about $437 from doing it right.
All right, that's another trade in the books. Let's end now with nat gas. Prices rising today thanks to that winter storm that's brewing outside. So, Brian, how are you trading nat gas? We got those inventory numbers today as well.
Yeah, I think that the supply demand is sort of interesting, but more so even the technicals I like looking at here. When you're looking at the charts here, 3.1, $3.10 has really been a level that we got above on the March futures contract and was able to stay above. So I'd be a buyer of the 314 level on the March futures contract, looking for it to trade up to 320 with the stop down at 310. I think you can use this sort of pullback that we had. We saw it jump a little bit on the winter storm, and now we've backed off the highs from this morning. I think you can use that to step in and buy right here.
Here's what I like about this trade, Courtney, is that we've had an unbelievably mild winter in the Chicago area. I'm not nearly in the cranky, bad mood I am in the first week of February that I normally am, so that must mean that it's warmer. We've priced in a lot of that warmth. To me, it seems like the net gas market always gets ahead of itself, and it looks way too much in the 10-day forecast, particularly when it's the middle of the country, right around here. So we've priced in a lot of warmth. I can't imagine that there's much more move on the downside, so I like this trade.
Oh, you actually agree on this one. Very interesting. Okay, so Brian, what's the risk reward then for this trade if we're playing along?
Well, if you're buying at 314, the reward to the upside is $600, and I'm risking 400 to the downside. Each tick is a tenth of a penny, and that equals $10. So certainly, I just like this trade from the technical aspect. I think we're due to go back up and test 320. I think the winter storm in New York sort of triggered that momentum, and I think we push a little bit higher.
It's like a reminder when we get a slap in the face with some really cold weather here, and it pushes out some shorts, and it's a very real reaction to it.
And the groundhog did see its shadow.
That's true.
The groundhog's a climate denier. Yes.
And it has been really mild here, too, on the East Coast, as well as what you're seeing and what you've felt so far in Chicago. But today, it's a very real reminder that it's still winter. Well, thank you, gentlemen, so much for joining us. Really appreciate it. That's going to do it for Futures Now. I'm Courtney Reagan. If you missed David Stockman's interview from today, have no fear. You can log on to futuresnow.cnbc.com to watch that and all of our other segments on demand. And remember, we give you real-time updates of all of our trades on Twitter. So be sure to follow us at CNBC Futures Now. Jackie, we'll be back for the next live broadcast Tuesday at 1 p.m. right here on futuresnow.cnbc.com. Have a good weekend and stay warm and dry.